So look, the fight on inflation is starting to work. As we said, year over year, we've got core CPI down from 6% to 5%, and we have core CPI at 5.6%. Now, again, this probably is still far from what the Fed wants at 2%. So as we look at the May 3rd Fed meeting, probably going to see a 25 basis points rate increase at that point. And then rents are still 8.8% of CPI, which is stubbornly high currently, as we would like it to be.
Jeff, if we take a look at the impact of the banking turmoil in recent weeks, there's still a big question mark. I mean, Jay Powell back in a news conference was effectively saying that there should be some tightening credit conditions that may do the job for the Fed, but that if it didn't happen, that the Fed might have to do more. You've been looking at this through the lens of the housing market. How much tightening do you think we're going to see in some of those lending standards, willingness to lend out to consumers because of the hit to the banks in recent weeks?
You know, it's a really good question. If you would have gone back 45 days ago, so in the U.S. housing market, there's two ways to look at it. If they're selling a conforming loan that can go to Freddie, Fannie, or FHA, I think the business is still, that's not going to be effective, okay? But if you're talking about putting stuff on balance sheet, which is a home equity loan or jumbo products, those have compressed over the course of the last 30 days. And we're seeing everybody, big banks, take a look at their lending standards and compress them to make sure they have enough liquidity, God forbid, should they need it on a moment's notice. So we definitely have seen a change over the last 30 days. And I think that we're going to continue to see that over the next 4 to 6 months until there's a sense that we're sort of on global stable ground with regards to the banking sector.
Jeff, as you've pointed out, one of the big differences in this report from the previous one was the change in the energy price. Unfortunately, since then, we've been overtaken by this OPEC cut. And if you just look at Brent, we're up 18% on the month so far. If we now think about what the next inflation report is going to look like, we've had a reversal then in the energy price, the headline oil price. We've also had a reversal in used car prices, it seems to me. Should we be concerned that actually we're going to get a reacceleration on headline?
You know, I think as we look at going forward right now, I think it's not going to be a reacceleration on headline, but if I bring this back into the housing market, you know, when people are looking to buy a house right now at an interest rate of about 6.5%, they can still put 5% down from an affordability perspective. And if that household is making $97,000, they can get into a house. I don't know anywhere else in the country where you can put 5% down and get into a house with that kind of an income level, that's the income level. So from that perspective, I think it is still very solid.
It's interesting you make that point because, you know, much of the focus on the wash up on the banking sector at the moment is just on how much tighter credit conditions and lending standards are going to be from here on in. And I still feel that we're not really out of the woods on this story yet. Do you anticipate that those lending requirements are going to get tougher here as we begin to understand just how deep the problem is in the regional banks?
I do. And again, I'll just kind of repeat this, but I think from the housing market perspective, then I'll go broader. From housing, it really comes down to if these loans have a place for a takeout, right? Like I said, back to a Fannie or a Freddie, I don't think that the lending standards are going to change that much from a U.S. housing market perspective. That being said, anything going on balance sheet, right, whether it be a credit card or being an auto or home equity, that is drastically changing for all the reasons you just said, especially on the regional, especially for regional banks who have obviously there's more concern around their liquidity. And again, it's where they have inverse interest rates right now, where they put money to work at 2% and they're paying off at 4%. So all those are coming back to still having a concern as far as to putting new assets on balance sheet right now.